I think since I'm from Parliament, I'm a politician, I want to start by doing a little bit of political framing. Rim, you asked in your introduction the question, what is the best way forward for the banking industry? And I would simply like to point out that the best way forward for the financial industry may not be the same as the best way forward for our economy in Europe. And I think that's a very important point to make, and it's a lesson we learned in the financial crisis the hard way. You know, there was a time when in America people were saying, you know, what's good for General Motors is good for America. And there was a time when we were thinking, you know, what's good for the financial industry is good for Europe. And now we know that this is not the case. And the reason why we've gone through many of the reforms that we've gone through is because we learned this lesson. And as Alain has rightly pointed out, there's one area where perhaps we haven't fully learned that lesson yet, and that concerns very large financial conglomerates, where we continue to have the problem of too big and too complex, too big to fail and too complex to resolve. And it's a problem that needs to be tackled. Now, of course, bank structural reform is not the only tool we have at hand for tackling it, but I believe it's a rather important tool to tackle it. And just to remind you of the importance of the implicit subsidy that still goes to institutions like that, it's estimated to the tune of 70 to 90 billion in 2011 and 60 to 80 in 2012. It might have come down a little bit, but these are large numbers. I mean, if you watch Juncker putting together a 300 billion investment package, not over 1 year, but you know, many years, and then you will realize that these implicit guarantees and the taxpayers' money that is implicitly or after a crisis explicitly spent on that is sorely missing elsewhere, which I think brings me to the second observation, that there is a question of whether these implicit guarantees are the best way to foster growth and jobs in the EU. And I would argue that's probably not the case. And so I think we need to tackle it, and more specifically, we need to look at the proposal at hand. As was already said, I'm the shadow rapporteur, and I think the proposal is going a long way towards tackling, to the extent possible within the framework of bank separation legislation, towards making a difference in that respect. But I would like to bring up 4 points where I'm not convinced yet that we are all the way there. One area is the question, you know, is this whole legislation in the end really going to bite? And as you know, in the proposal at hand, the idea is, other than the ban on proprietary trading, I'll come to that in a minute, the proposal basically says, well, EBA needs to define a metric on a certain number of parameters outlined in law, but it needs to define a metric. Then the Commission needs to come back and secondary legislation to define thresholds, and then it will be at the discretion of regulators to see what they do with it. And of course, the degree of discretion is also defined in the legislation. And it's not entirely clear to me as a parliamentarian dealing with that proposal what the final outcome of that process would be. And I think we need to think hard on whether we may wish to strengthen some of the precautions taken perhaps in the form of a backstop in the legislation to make certain that in the end this regulation is going to bite, which isn't clear. And so I think that's one area to look at. Perhaps we can develop a very simple metric that would address the problem of the very largest banks and very large trading activities right from the start with in the regulation. I think that's one area. Second area is the question of, that was already mentioned, of shadow banks or alternative investment funds. And I think for good reason there's a ban on the core banks to own alternative investment funds where they might continue sort of their trading activities in disguise. I think one area that I see missing, I'm not certain whether core banks should be allowed to give credit to alternative investment funds on a large scale, which for some investment banks is an important business. I'm not sure, on grounds of allocation of capital, I think the logic of banks engaging and leveraging alternative investment funds is weak. And in terms of importing risks from the shadow banking sector, if then the shadow banking sector engages in proprietary trading, against which I'm not necessarily, I mean, that's fine, as long as they're not leveraged, as long as they don't play the game that banks have been playing of, heads I win, tails you lose. Hedge funds, they can potentially play that game if they're extremely highly leveraged. I mean, I just want to remind you of long-term capital management problems. But if they're not highly leveraged, if they have a lot of loss absorption capacity, just because investors of all sorts of all kinds and shapes have put money in there and they want to have the money at risk, that's fine. But if they want to be leveraged, I'm worried, and so I think on the ban for the ban on proprietary trading, we may wish to also think about not allowing core banks to leverage shadow banks. Then there is an important question. It's a technical one, but still I think it's an important one and sometimes overlooked. If you do separation under holding, then the question is, to what extent do you really have two units that operate and potentially fail independently of one another? And that's not entirely clear for two reasons. There's sort of a very simple reason. If one subsidiary gets into trouble, then at the holding level you could decide either to raise fresh capital, say for the investment banking arm, or you could decide, well, it's actually difficult in market environments where banks get into trouble. It's generally difficult to raise fresh capital. Why don't we look into our other subsidiaries, whether they may be able to contribute by doing a special dividend or that sort of thing, thereby, of course, reducing the capital buffers in the core bank. And that's something that could happen. If you have a slow motion failure, a lot of capital could be channeled through by way of the holding to an ailing investment bank. But what's more, if for some reason, and that is important if you think about single entry resolution, at the holding level, you can incur debt, possibly bail-inable debt. Then the question arises, if you're a creditor to the holding level and you're asked to be bailed in because of troubles in the investment banking arm, wouldn't you have legal recourse on the other assets below the holding? And I think the answer would be yes. And so this is something we need to look at much more closely. It's not only how to get to separation, but then the question, how do you really make certain that in a separate structure or at a holding level, separation works and works in a way that it's intended to work? So I think that's an area we need to look at. And finally, we need to look at the question of not only separating investment banking and core banking, but also the unresolved question. And if you look at Brisbane and so on, it was clearly acknowledged as this unresolved question of how to resolve, credibly resolve, large institutions operating in multiple jurisdictions. And if you look at some of the questions that were posed on TLAC, I mean, it's interesting to note that the question was posed on TLAC, do we need to have a clear allocation of total loss absorption capacity, that's what TLAC stands for, clearly allocated to different jurisdictions? And so I would be inclined to ask the question in bank separation, do we perhaps not only need to worry about separating core banks and investment banks, but do we also need to worry about how to deal with problems of being able to resolve in multiple jurisdictions? And even within the EU, as you know, when it comes to resolution, we haven't solved the problem if in the College of Supervisors or if there's no agreement. There's no binding arbitration mechanism at the level of IBA, which makes it even more pertinent even within the EU. So these are 4 points that I think we may want to take a closer look at to make this excellent proposal even better and even more workable one. Thank you very much.